The purpose of this video is to discuss valuation issues that arise with property, plant, and equipment. Recall from an earlier video on the introduction of property, plant, and equipment, where I discussed what are the costs that you can capitalize. And the overriding theme there was we can capitalize necessary costs to prepare the asset for its intended use, right? Which included a whole bunch of things. But in this video on value of a transaction, what I'm trying to get you to see is some of the nuances that sometimes arise when we are dealing with this. So I'm going to start out with a very simple example so that you can see what I mean. But beforehand, in general, the idea of valuing a transaction, even though I'm discussing it in the context of property, plant, and equipment, for accountants, this is a very universal theme. Okay, we are always trying to figure out how we value that transaction, and in general, the way we would say it is we use the fair market value of either what we receive or the fair market value of what we give. And then that raises the question, so which are the two? What we receive or what we give? Which one is the one that guides the fair market value of the transaction and hence the amount that we record? And the rule is basically you're going to choose the one that is better supported. There's more evidence to support that value. So let me give you a few examples here. Straightforward. We buy a truck, property, plant, equipment, that is listed for sale for $16,000 and we purchase it for $13,900 cash. Okay, so this is your typical example of purchasing a property, plant, and equipment. Now, in this case, you could use the value of the truck, which is what you receive, or the value of the cash, which is what you give. Now, obviously, cash is the best metric of fair market value, right? So instead of relying on the listed price of the stock, the truck, we use the value of the exchange of cash. Okay, so that one's straightforward. We understand that. So we hence value the transaction at $13,900. We capitalize the truck and then we credit cash for the amount that goes out of our pockets. All right, so here's a secondary scenario. Same truck, it's listed for $16,000 and we purchase it with $2,000 down payment. Okay, so that one's clearly supported in terms of fair market value because that's cash. But then on top of that, we issue a zero interest bearing note of $13,000 due in 1 year. Okay, the value of this component is not $13,000. The value of it is the present value of that future cash flow. So I'm going to have to compute what that is worth today. And that's this calculation here. You do the present value of $13,000 for 1 year at 10%. And I'm making up this discount rate. Okay, this will be the customer's rate. And it gives me $11,818. Okay, so why is that important? Because in this case, again, even though the truck is listed for $16,000, the value of the exchange is going to be based not on what is received, but instead of what is given. And what is given is cash of $2,000. Okay, so that's clearly supported by fair market value of the actual cash itself, the note itself. And then here, a note worth $11,818. Even though it has a face amount of $13,000, it's worth $11,018. So in this scenario, we would say the value of the transaction of this exchange right here is $13,818. And this happens very often where we have several numbers that we need to think about in terms of determining what this exchange should be. Let me move on to another example here. Same truck. Okay, so we're all dealing with the same truck that is listed for $16,000. And we're going to exchange this truck that we're buying for company inventory. So we're going to give computers, in this case, we're saying, to the seller of the truck, and then the seller gives us the truck. It's an exchange. And the computers cost us $12,000. That was their original cost to us. and are normally sold for $15,200. So we normally sell these computers for that amount. So in this particular case, since we have transacted before and we have sold these computers for this amount, then that's supported by good evidence. So we would value the transaction at $15,200. This means the truck goes in our books for $15,200. We remove computers from our inventory, and the difference we credit to gain, $3,200. Because remember that we had bought these at $12,000 and we're marking them up $3,200, so that's our gain. So in that particular scenario, that's what we would record the transaction at. All right, last example here. Same truck. So in all these scenarios, notice how I'm trying to use the same asset that we're buying that is listed for $16,000. And so far in none of the scenarios we've actually used the $16,000 to value the transaction. All right, but in this case, we are acquiring a truck and we're exchanging it for our company stock. So whoever the seller is of this truck has agreed to accept 1,000 shares of our stock. Has a par value of 10 and has a market price of 13. Now, very important, I'm going to tell you that the market price of 13 was determined on a stock exchange. So in other words, this company is traded, is publicly traded. So that value of 13 is quite reliable. So because of that, we're going to go in here and we're going to value the transaction at 1,000 shares times 13. Meaning $13,000, and we would say the truck technically cost us $13,000. So then we issue the stock, credit common stock for the par amount, and then the rest is additional paid in capital. All right. So notice how in each scenario I'm trying to determine what is the best metric for determining the value of the exchange, and in all of these, it's the amount that I give, right, instead of what I receive. But it could be the other way around as well. So suppose that in this scenario, the stock price could not be determined because of the fact that it's not a publicly traded company. It's privately held. Well, if that's the case, if you were facing that scenario and you don't have a good measure of what the shares are worth, then you might have to try to figure out what the truck is worth. Okay, so you might have to go and we have Kelly Blue Book valuation metrics. We have different things that we could use to determine what that truck is worth, and then we would determine that as the value of the transaction. Different scenarios call for different actions, right? All right. You'll notice I have some things here that are blacked out, and I just want to point out a couple things. This is not the only way to record these things. You know that in accounting, we have several ways that companies choose to do the debits and credits, let's call it, or technically record this. So, in this one in particular, we had a truck that we put in the books at 15.2, and then I recorded the gain of 3,200. I could have done this differently. I could have just, recorded this as revenue and cost of goods sold, and that's what this is here. So let me open this up so you can see what I mean. So another scenario would be I could do cost of goods sold and then remove the computers from my books, and then at the same time the truck for 15,200 and recognize that as revenue of 15,200. Now, the difference here of cost of goods sold and revenue, the difference between cost of goods sold here and revenue is still 3,200, right? So in the income statement, you'll see that 3,200 as opposed to directly as a gain. Either way works. Either way is an approach that companies use, and you have to be aware of what companies are doing. So if you're working in a particular client, you need to understand whether they initially recorded it like this or they chose this route, and that for you should not be an issue, because both of these mean the same thing, right? From the perspective of accounting. All right. Going back to number 2, the way I recorded this transaction would be referred to as the net method, right? If you've looked at earlier videos where I talk about the gross and net method of recording receivables or payables, then you would understand that this is the net method. We also could use the gross method if we wanted to. So let me display that. Oops. Bear with me here, I got mixed up. So if we wanted to use the gross method, we would use a discount account. So in other words, these two right here, let me paint these yellow. These two right here, in essence, would be taking the place of just one credit for 11,818. This would be the gross method. You would still record the truck at 13,818. Notice how that doesn't change. But now, oh, I'm missing something in this journal entry, my bad. Notice how here, the cash is still 2,000, that doesn't change. But I include the note payable at the gross amount, 13,000, the future value. But if I do that, then I need to include this discount on notes payable, which is a contra liability, reducing the note payable. So at the end of the day, this is still a note, a net carrying value of 11,818. And either way is fine. There's no difference from the perspective of the accountant. It accomplishes the same thing. Now, again, you have to be aware of what the company itself is doing so that you can do the accounting correctly afterwards. So, in other words, eventually you will have to pay this note, and there's going to be interest involved. So, if you use the net method, what would you do? You would eventually debit interest expense. Well, let me show it to you here. So you would debit interest expense for the amount above the 11,818, right? Because that's a financing expense. That's not the cost of the truck. Don't mix that up. And then you will reduce the note payable for the amount, the net amount, and then pay cash of 12,000. It's really important that you understand this concept here, because if you do not separate what amount belongs to the basis of the truck versus what is a financing expense, then technically you would be overstating your asset. In other words, this 1182 should not be part of the truck. And if somebody does this incorrectly, they could have put note payable 13,000, cash 2,000, and then truck 15,000. Now, there's a financing component that needs to be separated, and that's what we're doing right here. Somewhat similar, if you were using the gross method, that amortization of the interest would look like this. So interest expense is still the same, 1182, right? But instead of crediting, crediting cash immediately, you have to amortize that discount. In other words, get rid of the discount. In this case, 1182, so you credit 1182. And then what that would do is now the note payable is at full 13,000. I think I made a mistake here. This should be 13,000. My bad. I put 12,000 in there, but that's 13,000. Hopefully some of you observed that and were concerned. There we go. This should be 13,000 because the note is due for 13,000 and the summation of these two is 13,000. Sorry about that. All right, so going back to this one here, we have interest expense. Then discount is amortized for that amount. We reduce the liability, and then we credit 13,000 of cash. All right, last thing I want to mention here is specifically with number 3 here. So I did this simplified exercise here for you to understand the value of the transaction. But sometimes these would be considered non-monetary exchange of assets, right? And if it is considered a non-monetary exchange of asset, then you have to follow the rules related to non-monetary exchange of assets for property, plant, equipment. So one thing is to understand the value of the exchange or the transaction, and then another is to have to understand the rules that are applied in these scenarios. So for that purpose, I encourage you to look at the video titled non-monetary exchange of assets, because when we're dealing with The exchange is shown here, a non-monetary. Notice how no money is being exchanged, okay? It's one asset from one company for the asset of another company. We may have limitations on how much of the gain we can recognize, how much of the loss is recognized, and also the basis that we can record for the truck. So please look at the details related to this topic. All right, but this concludes the video on valuation issues that arise with property, plant, and equipment. And also in general, remember, this idea of the value of transaction is a universal concept that we apply throughout, not just in property, plant, and equipment.